So giving us a little bit of insight into what the UK markets look like and where the hotspots are for healthcare innovation investment is Henry Whorwood, who's the Managing Director of Research and Consultancy at Beauhurst.
Thanks, Jane. Good morning, everyone. I'll start by thanking Jane and Discovery Park for asking me here to speak to you this morning. I'm going to talk to you about four things. I'm going to give you a little note on what the global landscape for health tech, health innovation funding looks like. I will then zoom in a bit more on the UK and talk about the overall investment landscape, and then the particular health innovation funding trends that we're seeing in the UK. And then I'm going to end, slightly perilously, with trying to forecast and say what might happen next year. It's just some light forecasting, and please don't hold me too closely to it, but I'll try and say what we think from the data might happen next year and beyond. Before I get on to that, I will tell you a little bit about what we do at Beauhurst, so that you can understand where our data comes from that I've analysed for you this morning. So we're a data company tracking the UK's economy broadly, and that's an important point to stress as I talk to a room full of sector experts. We are sector agnostic. We track all sectors, and we're interested in every single company in the UK. But in particular, we're interested in those companies that are innovating or growing or doing both. So from amongst the UK's 5 million companies, we try to find those that are on a growth trajectory, that are innovating, that are inventing something new. And we do this in a variety of ways. One of the key signals for us that a company is on an innovation trajectory is the use of equity investment. It's a type of finance that is generally used when something in a business is being innovated. And that's the main sort of data point that I've analysed in my slides today. I'll come on to a bit more about where we get that data. But we do look at a broader universe of how businesses approach innovation. So we're interested in all the companies that spin out of universities. We look at any company receiving any amount of money from Innovate UK and, at least formally, Horizon 2020 and the programs in the devolved nations and sort of any kind of innovation grant that we can see to a UK company. We look at venture debt, we look at companies that are growing organically, we look at companies attending accelerators, we look at companies based on where they're located, if they're located in an innovative place like a science park. All that helps give us a signal, helps us understand and identify the companies that are growing in the economy or have the ambition to do that at least. So there are 5.36 million companies in the UK. About 28,000 of those have used equity investment. And by equity investment, I mean from a friends and family round where you're selling shares in your business just to get it off the ground, through to angel rounds, through to VC rounds, through to growth equity, and ultimately on to exit. So we track that full life cycle. And from those 5 million companies, it's a very small population. So the companies that are looking for investment, like the ones that we'll pitch later today, are a very rare cohort in the wider economy. But we track all of them. And that means since we began in 2011 doing this, we've tracked nearly 72,000 investments into these companies. They've been worth 156 billion to the companies in question. Again, this is all sectors, not just health innovation. The median deal we're tracking is 256K. So we track absolutely everything. And those deals are what I'm going to analyse today. I mentioned already as a caveat that we are sector agnostic. As another caveat, we are focused on the UK. But I'm going to show you another data provider's data just to talk about the global trends that we're seeing. And this comes from PatSnap, who are a data provider on patents in particular, but they also track funding to those companies as well. And this chart is showing investment into the sort of broadest definition of health innovation. So it includes life sciences, it includes biotech, but it also includes digital health, e-health, things like that. This is a shape of graph that you should get used to this morning. You're going to see it again with things peaking in 2021, and then in the subsequent 2 years, 2022, 2023, seeing, you might want to call it, some people calling it a correction, other people call it a downturn. Anyway, fewer deals and less investment than in the peak in the immediate post-pandemic peak. And there are a lot of factors in the macro environment as well as in the investment landscape that are driving that. And I think the purpose of my remaining slides is to try and arrive at a conclusion about whether that downwards trajectory is going to continue or not, and how many deals we can expect to see in the coming year, and broadly for the companies in the room that might be looking to raise, how much harder is it going to get than it was in the immediate post-pandemic period. But as I said, most of my slides are on the UK, but you'll see that the trend is broadly comparable. So here's your second version of that same slide. This is using our data at Beauhurst and looking at investment across all sectors. So this includes health innovation, but includes all other sectors as well, just where the instrument being used is primary equity. And you can see the same trajectory of peak in 2021, a slower downturn in 2022, and then accelerating into 2023. If we look at a quarterly picture, so same data, all sectors, quarterly, this is now just quarterly instead of yearly, and just to be clear, includes all stages as well. So this includes seed stage, venture stage, growth stage, absolutely everything there. You can see it's a bit slower of a decline, and you see a bit more of the levels of volatility that we see anyway in the amount of investment per quarter. But you can see a general downward trend, and actually it appears to have sharpened immediately into the Q3, which is the last quarter we have full data for. So Maya included some optimistic notes at the end of his talk, and I will try to come on to some of those eventually. But I think actually there's not an unfair reading of the data that actually it might get a bit worse. I will try and be even-handed and not a massive pessimist in all of my slides, but it's worth noting that you can see the trend appears to be continuing. It hasn't stopped yet. Right, now on to the sector you all care about. This is health innovation in the UK. Again, you can see broadly similar trend, just smaller numbers because it's a subset of what we were looking at before, but the same trend that it peaked in 2021, declined the year after, and has declined. Yeah. Bear in mind, for all of these ones where the final bar on the right is 2023, which was still in, so they will correct upwards a little bit, but enormous deals happening just before Christmas are a bit of a rarity, so they won't correct that much. But I think the optimist in me wants to say, if we say it'll correct a little bit, we'll get to around 700. That takes us back to 2018, 2019 levels, so pre-pandemic levels, which were, compared to, say, 10 years ago, significantly higher. So we haven't corrected all the way back to a decade ago. We've just corrected back to the pre-pandemic volumes that we were seeing. A couple of reasons for why I'm calling it a correction and not necessarily a downturn. I think the correction is what we're seeing in the data, and I think the downturn might be what's left to come. The reason I say that is because these peaks in 2021 in particular were caused quite a lot by tourist investors, is what they end up being called. These investors who were new to investing in either private companies or in certain sectors, who did some pretty outsized deals, and then they've left the market as soon as there was macro tightening, basically. So a lot of that people driving this activity have since left the market. So that's the sort of correction effect. All of the investors who were there prior to the pandemic are still here, still doing deals, but those investors will be facing very particular pressures from the macro environment. If you look at the quarterly picture, it's a bit more resilient than the all-sector quarterly picture. It's a bit flatter in the deal numbers. Just a note on all of these bar and line graphs that I've been showing you. Generally, I tend to take the line as a stronger signal of the health of the ecosystem. If you think about it, the amount of money raised is often a function of the requirements of the business, so it's a bit more volatile to the nature of the underlying business, whereas whether the deal happens or not is a bit more influenced by the macroeconomic conditions. So the fact that this line is a bit more flat than the all sector line I showed you shows that there is the level of investment activity in health innovation is more constant. So there's a shred of optimism there for you. I'll come back to a bit more about what I think is driving those investment volumes and what might cause those to happen, cause those to change or not in the future. But to look a bit at the deals that are happening a bit more, and sorry, at the back of the room, you might not be able to see this at all, but this is showing the average valuations. So it's a different metric. If we're looking at all of these deals, we see the amount raised and when the deal completed, and we also see the valuation it happened at, which is another way of gauging the sort of health of the ecosystem, because it's an indication of the investor appetite into the deal. I know there's a session on valuations later. I think what's worth noting is this. So this is for all health innovation deals that we can see. The line at the bottom is seed stage, the line in the middle is venture stage, and the line at the top is growth stage. You see that the growth stage has been the most volatile. That's where I would put a lot of that down to tourist investors again. Whereas you can see a steady upward trend in the seed stage and in the venture stage there. So at the same time as we talk about investors coming and going and investor appetite changing, another dimension is what they're willing to pay for those companies. And so if you look at deals declining but valuations going up, that means that broadly investors are doing fewer deals, but the deals that they do, they are happy to pay a higher price for. So whether you can make a direct inference from that as to the quality of the underlying investee companies, it's harder to say, but certainly from the investor's perspective, they believe that they're seeing a higher quality, or believe that they will get a higher valuation out from it in the future. Just a bit of navel gazing in the sector then. Who's doing these deals in health innovation? So firstly, the top investors by deal numbers. Scottish Enterprise often tops quite a lot of rankings because they're a co-investor model, so they will co-invest in any eligible deal in Scotland. That they are the top here speaks to the strength of the life sciences ecosystem in Scotland, but they're very much a co-invest model. Access EIS is the EIS fund run by Syndicate Room, which also has basically a co-invest model. They're just co-investing with angels rather than with VCs. So if you are an angel that they have ranked highly enough, the Access EIS fund will look to do half of the round alongside the angels. Syndicate Room are based in Cambridge, so a number of those angels are have a deep science focus, which is again what pushes it up the ranking when we're looking at health innovation investors. Bit more unusual to see Crowdcube and Seeders on there. That's more for the digital health, e-health side of things. Normally, if you look at the all sector picture, Crowdcube and Seeders would be at the top by volume of deals facilitated, because they're not true investors, they're just facilitating the flow of money. They'd normally appear top, much less exposed to health innovation generally, but to some health tech, e-health applications. They do some of those deals, especially if it's a consumer product in general. The kinds of companies that come to the crowdfunding platforms have a consumer proposition because they're trying to make investors out of their consumers or prospective consumers. You see Octopus there. They have a health tech fund, so no surprise to see them on here. Mercia again with their tech funds in the same vein. Old College Capital, which is a co-investor out of Edinburgh University, I think. I knew it was one of the Scottish ones. So they're investing into a lot of the spin-outs that come out of that university, and I'll come on to talk about spin-outs in a bit more detail just after that. SFC Capital, just a very prolific early stage investor as well. By amount, the picture looks a bit different. There's SoftBank, one of those potentially tourist investors. That's maybe a bit disparaging, but sort of in that category on that list. CIC at the top, Cambridge Innovation Capital investing into Cambridge spin-outs, so that's why they're here. It's a bit easier to sort of get onto this ranking because you only have to do a handful of very large deals. So this is looking at the very largest end of these investors. Right, I'm coming on to show you some data that will influence my sort of prognostications about the future. So this is showing health innovation exits over time. So basically, sales either to a financial or trade buyer or IPOs over time. Again, you see a similar sort of trend to the previous slides. I mean, much bigger sort of immediate post-pandemic jump and a much bigger correction as well. This is very important because I think the real issue facing not just the health innovation sector, but all sectors in the UK for tech, basically, it's liquidity. Liquidity is the real crunch that's going to become a problem in the next 12 to 18 months. It has knock-on effects to access to capital, but I think for the past 10 years, especially us at Beauhurst, we've been banging on about access to capital as an issue. In the post-pandemic era. I think access to liquidity, which is a lens on access to capital, is going to become the key issue. And this, this illustrates it quite clearly. We need this graph to go up and to the right fairly soon. Just for variety, to show you a graph that looks slightly different from all the others. This is showing investment into the overlap between health innovation and AI. So any health innovation company that is using / more developing in our definition is kind of hard to tell some of the time, but we've tried to look for the companies that are developing something proprietary in how they use AI. And particularly if you look at the line there, you're seeing a much more up and to the right trend. So if you have a bit of AI in what you're doing, you might be finding it easier to raise than your non-AI counterparts. Again, a bit of a correction at the end, but it's partial data for 2023. Amounts down quite a bit though. Again, and we see that in the AI sector broadly as well, of like deals are still being done. They're a bit smaller. You can sort of say this across all sectors. In general, the deals are smaller, taking longer to close and a bit more tentative. So just to try and prognosticate a bit, I'll do the gloomy bit first, and then the potential reasons for optimism after that. So I've shown you all those charts of the deal volumes. We can see there is either a correction or a downturn happening depending on your perspective. One of the points when I say, look, I think that trajectory might continue, one of the challenges I get given is, but we hear so much about the amount of dry powder that VCs have during the pandemic period. Just as companies were raising lots and lots of money, VCs were also finding it very easy or easier than they ever had to raise money as well. So haven't they got these huge pots waiting to deploy? And to an extent, they have. That's why I would say we've had sort of the correction, not the downturn, because they've still had some money to deploy. But those dry powder numbers that get cited are usually wrong in terms of how you think about it, because the money gets committed but not deployed at the point that the fund closes. So all of the LPs in a GP, so the limited partners in a venture capital general partner, have strains on their liquidity as well. Okay, 5-minute warning. And I want to come on to the positive bits as well. So they have strains on their liquidity as well. So they may have said to VC Fund A that we are happy over the lifetime of your fund to commit £10 million. They sent when the fund got going, they gave 2 or 3 with a program for what they would deliver over the rest. But that delivery is from them, from the LPs to the GP, is reliant on them it's the LPs having some exits or having a fund that performs really well. So as much as everything can sort of spiral positively up from that, from the way these things overlap, when there's a bit of a downturn, you get a negative feedback loop here, and we are starting to see that. So the funds have run out of money that was actually given to them, and so now they're trying to draw down on these commitments that were made, and they are finding that harder than it ever has been before. That is because there are fewer exits and less M&A, less IPOs returning money to LPs and others. That will then trickle into the sort of front of the system and mean fewer angel deals are happening, so fewer new companies get funded. More VCs end up competing for more deals. Valuations can go up, but that actually makes it even harder to get the liquidity you need out at the back end. So that's where the correction, that's where the downturn might come. I think we might start to see that. All of this being driven by interest rates. So the pressure on LPs is partly being driven by interest rates. So if interest rates carry on an upward trajectory, which they could do in the UK, even as the US is signaling that they might not, that will further compound that problem as well. Just a moment on the positives. So I'm generally here talking about just the dynamics of equity investment into early stage private companies outside of health innovation. So what are the positive things, potential positives? That means that pessimistic scenario might not happen in health innovation. Well, there's the role of all the other types of finance that are available to health innovation companies. In particular, the huge role played by grant monies can help keep these companies buoyant for longer. The fact that of the exits that we have seen, a much larger majority have been in health innovation. So they've remained, they've become a larger proportion of the exits we're seeing. So there is more liquidity in health innovation compared to, say, B2B SaaS at the moment. And then finally, also something I haven't really come onto in my slides is the difference between generalist investors and specialist investors. Obviously, health innovation is a sector with highly specialized investors who can't get distracted in the same way. So the corollary of that graph that I showed with health tech, innovation and AI shooting up is that your base of investors are a bit more stable and can only invest in the things that their original thesis was. So that money gets a bit less easily distracted, whereas a lot of the B2B SaaS VC investors have all been distracted towards a kind of deep tech AI that they hadn't been previously thinking that they would invest in. So there's some very mild positive reasons. I think that is my final slide. And sorry, have I run over? Lovely. Thank you very much.